Regardless of how smart, talented, or hardworking you are, the market is unpredictable. And if you're not careful, you could lose everything in an instant. During the pandemic, even Warren Buffett, who was hailed as the third richest man in the world, lost his position to people like Elon Musk, who must have been quite far away from him at the time, when his conglomerate Berkshire Hathaway reported a net loss of $50 billion after a pandemic swept the world. This tells us that even the greatest minds in finance aren't immune to unforeseen events. Despite the fact that the company recently reported a profitable quarter, its stock price has yet to recover to pre-pandemic levels. In this video, I'll walk you through 5 investing mistakes not to make in 2022. But before we delve deeper into that, make sure to subscribe and hit the notification bell so you'll be updated whenever we upload new videos like this. Mistake number 1. Confusing investing with trading. Amateurs who are just starting out in investing imagine having to find new cool stocks to invest in every day or week. And if you haven't invested in a single company for the entire month, you aren't an investor. There are 2 types of people in the stock market: investors and traders. A trader is someone who buys a stock with the intent of selling it the same day or within a few days, because the goal is not to invest, but rather to buy the stock and profit from market volatility. Have you seen how quickly stock prices can fluctuate? Every minute, if not second, they jump up and down. For example, the price may start at $100 and end at $105. So if you trade with $100,000, you can expect to profit $5,000 in one day. It appears to be a simple way to make money in theory, but in practice, it is far more difficult. In the short run, stock prices are almost impossible to forecast. And as a trader, it doesn't make a difference what stocks you purchase. Even if these companies are absolute trash because you're not hoping to keep your money there, which is what distinguishes it from investing. Investing entails purchasing small pieces of businesses that produce something meaningful and grow over time, as does the value of your investment. So if you know of a company that is doing well and you know what it will be in 5 or 10 years, you might keep investing into that company rather than reading endless financial reports and wasting your time analyzing endless financial statements. Number 2. Investing emotionally. When the price of a particular asset rises dramatically, a large number of people who were previously uninterested in investing become interested. Remember what happened with Bitcoin a few years ago? The price rose so dramatically that people who had no idea what cryptocurrencies were, how blockchain worked, or the technology behind it, suddenly started buying Bitcoins, hoping to make a fortune. I'm not disparaging Bitcoin, blockchain, or cryptocurrencies, but investing based on emotions is a bad idea. Typically, it ends up being disastrous. Bitcoin is one such example. Remember the mortgage crisis? Even the most qualified investors couldn't help but get involved. However, the entire system collapsed, and some countries are still dealing with the fallout from that crisis. In the late 1990s, even giant tech companies like Yahoo made a bad decision by investing a few $1 billion in Broadcast.com, which they had to shut down 2 years later. But it was Mark Cuban who was foresighted enough just to sell his shareholding before everything fell apart. Here's a general rule of thumb. If it was already in the news and rising rapidly, you've missed your chance. Accept it and don't beat yourself up over it. The cycle may have reached its peak by the time you arrive. Whatever investment you make should be based on the calculated risk that is rational. Of course, you may miss out on some fantastic opportunities, but you will avert the risk of losing all of your wealth and building a long-term portfolio. Warren Buffett, the world's greatest investor, passed up opportunities to invest in Google, Amazon, and a slew of other great companies. There are 2 types of stocks worth purchasing: those with a promising future and whose current stock price accurately represents their value today, rather than 5 or 10 years from now. Secondly, is a stock price that is undervalued for one reason or another. Everything else is a waste of your money. Number 3. waiting too long to start. Time is everything when it comes to investing. The sooner you start investing, the more money you'll make. $100 invested at the age of 20 will grow to $466 by the age of 40, while the same $100 invested when you're 30 will only be worth $215 when you're 40. That is assuming you invest in an index fund with an annual rate of return of 8%. I know you're thinking, let me figure it out, or wait until I figure it out. But that time will never come. You will always be unaware of something. It may sound a little controversial, given that I just warned you not to invest if you don't know what you're doing. That is correct, but you do not need to be a financial genius to get started. If you're not familiar with the stock market, consider investing in an index fund. Begin with a portion of your savings or a portion of your monthly paycheck, and then give yourself some time to learn. And once you've educated yourself, you can invest in companies you believe will outperform the S&P 500 in general. You may not have the time, but you do not have to spend hours every day looking for companies. It must be done once or twice a month. And once you've found a good investment, stick with it. Number 4, not being able to look outside the stock market. Real estate is one of the most interesting investments, but it is not always the best. The best investment you could ever make could all be in businesses you started yourself. The stock market exists to keep your money growing while you are primarily focused on growing your own businesses. Because if they are kept in a savings account, inflation will eat them away. Invest in stable companies with room for expansion. What you can expect from the market at most is 7 or 8%, and at most 10%. However, it will still surely vary from year to year because there have been instances when the S&P 500 rose by 20% or more. However, when it comes to small investments in small businesses that appear to be working, returns can be a few 100%, if not thousands of %. You have the ability and power to make a difference. You can't do anything with these multi-billion-dollar corporations. Don't let the stock market fool you. The best investment for you could be right in front of your eyes. And finally, mistake number 5, investing what you can't afford. It's simpler to become enthralled by the prospect of investing. I understand. You see all these numbers and want to jump in and nail it so that your bank account is filled with these green papers, or more precisely, with those numbers. However, you must consider other factors before investing. For example, if you need the said funds over the next few months or so to sustain your basic expenses, it is not worthwhile to invest. Because the market is unpredictable. Even if it is a large and stable company, it will most likely grow in the long run. However, the stock price may fall in the short term. When you unexpectedly need money to cover your basic expenses, you may have to sell your investment at a loss. Don't get too excited. Of course, begin as soon as possible. However, be reasonable about the amount you want to invest. It is preferable to begin with something small but consistent. Even if it is only a few $100s per month if you've just started investing or are thinking about it, keep these blunders in mind. It's excruciatingly painful to lose the money you worked so hard for in the blink of an eye. I'm not saying you'll never lose anything, because it's a necessary part of the game. However, minimizing losses and mistakes is a critical component of success in any endeavor, including the stock market. And that, my friends, concludes today's video. I hope you gained some usable wisdom from it. Now, if you want to learn more about this particular topic, don't forget to subscribe and make sure to hit the notification bell so you will be updated whenever we upload new videos like this. Thanks for watching. See you in the next one.